Module 3 is credit, budgeting, and how you qualify. A lot of people misunderstand credit. We definitely need to talk about budgeting and how you qualify in terms of debt to income ratio. What income do we use? How do we qualify? What's a front? What's a back ratio? You're going to know all that stuff so you're informed when you go to buy a home. It's very important stuff that they don't teach in school, and we're going to get to it. Credit and budgeting and how you qualify. This is exciting and often misunderstood, so I'm so excited to bring this to you. Credit. Let's start with credit. Guys, credit is a temporary thing if you make it. What's permanent for people is their habits, okay? If you pay your bills late, you're not gonna have good credit. Collections and judgments kill you. Here's why. A $38 collection or judgment literally hurts your score by 40 or 50 points. And if you're 40 or 50 points lower on a credit score, you literally might get a quarter or 3/8 worse on an interest rate on a mortgage. So you cannot have collections or judgments. It cannot happen. That kills your score. Also, revolving debt, credit cards. When you have a $10,000 card, you can't have more than 50% balance. Now, that's the first threshold. The second threshold is 30%. 30% is ideal. So if you have a $10,000 card, you want to owe less than $3,000. Now, say you have 3 cards, each with $10,000 limits. Some people think, well, if I owe $9,000, I'm still at my 30% utilization. That's not how it works. It's individual cards. So you can't have more than 30% revolving debt on each individual card. If it's 50% or less, it's okay, but 30% is ideal. Now, when your credit gets pulled, I hear literally every day, well, I just had my credit pulled a month ago by another bank. I really don't want you to pull my credit again. The credit inquiry is less than 5% of the total score. So if a lender pulls your credit and then another lender pulls your credit 2 weeks later, it's not the end of the world. So we have to keep our revolving debt down, okay? And we cannot have any collections or judgments. Also, the bureaus judge you based on the longevity of the relationships that you guys can have. Meaning, if you've had a credit card for 15 years and another one for 12 years, you're proving that you can be in a relationship with a vendor without screwing it up, right? Hopefully there's no late payments. That helps your score. When you get that 20% off at Home Depot, when you open a card and then you decide, I'm just gonna close it a week later and then open more, they don't like that. They like to see 3 to 5 cards active and continuing throughout a lifetime. We don't need 20 credit cards. That hurts our score because there's too much activity. A little bit more on credit. So when you go to get a loan, we're taking the median score, which means this. It's 720, 700, 680. We take the middle. Take the middle number. We don't take 3 scores and divide by 3 and get a number. That's not how it works. We use the middle score. Now, about 3 years ago, something came out where Freddie Mac has this credit score averaging. So you could have a 750, a 680, and a 620, and they actually average the scores. That helps, especially when there's a husband and wife and one of the two has a lot lower score, but we need their income to qualify. So let me give you an example. So say the wife had a 600 score and the husband had a 720 score. They actually divide. Now, many lenders don't do that program because the bond market doesn't love them, but that does exist with Freddie Mac, and there are some lenders that do it. So the credit score average is a really good product if one of the two in the relationship doesn't have high credit. Now also, if you look at the chart, 740 credit, it actually just went up to 760, gets you the best interest rate. And every 20 points on conventional loans that your score goes down, you get a little bit worse interest rate. With FHA, it's not as sensitive as conventional. So you could have a 680 or a 660. It might be a little bit worse, but conventional is definitely much more sensitive to it. Now, I had mentioned this earlier. There's a few factors that decide if you're putting 5% or 3% or even 10% down when an FHA loan is appropriate and when a conventional loan is appropriate, but it depends on a few factors. But if you're putting 20% down and you have a decent credit score, then clearly that's going to be a conventional loan. So be careful with your credit. It's okay if a lender or two pulls it, but let's make sure that we're smart with our revolving debt, no collections and judgments, and keep your relationships. By the way, check us out on TikTok and some of our social medians, because I have a good following on TikTok, and sometimes I go on rants. One of my rants is student loan debt. It aggravates me, and I'm here to make sure we tell you guys the truth. So, do you guys know what negative amortization is? Negative amortization is when you take a loan and you're allowed to make a minimum payment or you're allowed to make no payment, and the balance actually grows every single month. In 2008 and 9, when the financial crisis happened, negative amortizing mortgages became illegal. But for some reason or another, because the government owns many of the student loan companies, negative amortizing loans are allowed with student loans. Now, here's what this is. You graduate from a university, you owe $80,000 on a student loan, and you get this letter saying it's okay to not pay it for the next 12 months. Oh, and by the way, call us in 12 months. We might be able to extend it for up to 3 to 5 years. And you, as a student, think you got a free lunch. This is amazing. I don't have to pay my student loans back for 3 years. Except it's negatively amortizing, meaning you owe $80,000 today. A year from now, you owe $83,000. 2 years later, you owe $87,000. And it goes up and goes up. So do yourself a favor. The minute you graduate college, there's no free lunch, guys. It only gets worse for you. We have to pay our debts. We have to pay our student loans down. We have to make sure that we do that immediately, because not only is it not a free lunch, it's actually making your balance bigger. Okay, so also, when we go to get you a loan, if your loan is in deferment, we have to hit you for a higher number on your debt to income ratio, which I'll explain in future slides. We have to hit you for a higher number than the actual payment would be. So there are 44 million Americans without standing student loan debt, and it's 1.5 trillion in debt. But only you can control paying off your own loan. Tax deductibility, one of my favorite slides. So let's get right into the heavy duty of this, because it's often misunderstood and most first-time homebuyers just don't understand it. If you look on the left side of the screen, mortgage and interest and taxes are deductible against your income. Now, with all things being equal from a tax perspective, if you pay $21,000 in interest and taxes on a primary residence, you will get $6,000 to $7,000 refund. Let me show you the math. Up on the top right side, $100,000 W-2 earner. If you're in a 32% tax bracket, you're going to pay about $32,000 a year in taxes being paid. And there's a couple different things. There's IRS and there's state and there's FICA and there's a couple other things. But just looking at the math, on a $400,000 mortgage, your principal and interest monthly is $1,740. $1,166 of that is interest, or $14,000 a year. And if your property taxes are $8,000, the total amount that you're going to pay in interest and taxes is $22,000. We simply take the tax bracket that you're in, divide it into the $22,000, and that's the refund you're going to get. Now, as I said, a few things have to be equal, and different states are different, so it could end up being a $6,000 refund or a $5,800 refund, but we're basically taking the bracket that we're in and we're dividing it into the mortgage, interest, and taxes we pay. This is not a if, this is not like, oh, maybe. It 100% comes back to you if your CPA writes off your interest and taxes. It's a huge benefit of ownership because it allows you to afford more and you get a check back once you do your taxes. Budgeting and how you qualify. So here's how you qualify for a mortgage loan. We're going to take in this module the W-2 employee. In future modules, we're going to have the self-employed, which we're going to get to. So for a W-2 employee, we take the gross income, that's before taxes, okay? So if you're making $100,000 a year, your gross income is $8,333 a month, okay? We take all of your payments associated on your credit report, not your cell phone bill, not your utility bill. Things like car payments, credit card minimums. So if you owe $3,000 on a card, that doesn't matter. It's the minimum payment associated. And if there's student loan, where you're making a payment. That all goes into what we call the debt to income ratio. Now, there's what they call a front ratio and a back ratio. A front ratio is your gross income divided into the mortgage payment. So if the mortgage payment is $2,300, whatever percentage the $2,300 is of the $8,333 of a $100,000 earner, that's your front ratio. Your back ratio is the mortgage debt plus the other debt that appears on your credit report. In the next slide, we're going to show you, but FHA and Fannie Mae have a little variances on what they allow from a debt to income ratio perspective. So here's a fun fact. If you're in college and you get a W-2 job, everybody thinks you need to work for 2 years. Not the case. If you get a salary job one day out of college, we literally can close a loan for you based on that salary. So that's really cool. A lot of students think they have to wait 2 years, okay? The next slide, we're gonna show you some graphs on how the DTI works with each of the regulatory bodies. Okay, more on debt to income ratio. In the previous slide, I talked about front and back, which you see here, okay? So DTI, once again, is your debt in conjunction with your overall monthly gross income. So if we look at the bottom, conventional FHA, VA, and jumbo. So your front, as I mentioned, which is your mortgage debt in association with your gross income, conventional stops. Actually, it kind of just raised it. It has on this chart 45%. If your credit's really good, they'll now allow for 47%. And then the back ratio can only be 49%. So basically what happens is, if your mortgage is 42%, you have 7% more room to have other debt on your credit report in conjunction with your income. FHA is 47 on the mortgage and 57 on the back. It's very funny to me. Sometimes listing agents will be like, well, we don't really like the FHA borrower because it's harder to get approved. And I'm like, no, it's actually easier to get approved because there's a greater allotment allowed for 57%. So sometimes people say, hey, is it hard to get people mortgages? I'm like, no, not if they have a job. Think about that. If your gross income is $8,333 and you pay 28 or 30% taxes, they're giving you 57% of total debt on your income. We probably don't want to go that high, but that's allowed, okay? Now with VA, it's 45% on front ratio mortgage debt. And the reason why it says discuss is because VA has a sort of a different algorithm that they look at. And sometimes they allow for a lot higher back-end ratio because it's a government agency that's trying to help the veterans because they helped our country. So it's a little bit more flexible. And then jumbo is a little tighter. And jumbo, depending on what state you're in, is above a certain amount of loan balance. So that's kind of how debt to income ratio works. Okay, some mortgage definitions, some basics here, but you need to know this stuff. Loan to value, okay, what is that? That is your purchase price in conjunction with what you owe. So LTV, if you buy a home for $100,000 and you put down 20%, that's an 80% loan to value, okay? Now, sometimes when people own a home, if they need to get money out of a home because they have debt or whatever, a cash out refinance will go up to 80%. So once again, 80,000 on 100 is how that works. Now, if you look at conventional, believe it or not, a lot of people think FHA is first time home buyer product, 3.5% down, and with conventional, you have to put 20% down. Not the case. Conventional, Fannie and Freddie have a 3% down program as well. FHA has a 3.5% down program. VA, thanks to the veterans, they have the ability to get 100% financing, 0 down. And jumbo, we could do a 90% loan with 80% on a first mortgage, 10% on a second mortgage. It's actually 2 different loans, but it equals 90%. So also, mortgage payment is also known as PITI, principal, interest, taxes, and insurance. Whenever you put less than 20% down, you have to have your escrows, right, your taxes and insurance, included in the mortgage payment. I actually advise that because you get one bill every month and all of it's taken care of. And escrows, taxes, and homeowners insurance with FHA, by the way, mandatory. With conventional, if you put more than 20% down, it's your choice. But as I said, I recommend it. So escrows is your mortgage payment, your taxes, and your insurance.